Welcome to the Deep Dive,
Yeah.
your shortcut to being genuinely informed. And today, wow, we're tackling a headline that practically jumps off the page.
Oh, yeah. What have we got?
Steel Authority of India Limited, SAIL, a real giant in Indian industry.
Absolutely.
They've just announced an incredible 273% surge in profit for the first quarter of fiscal year 2026. That's Q1 FY26.
273%. That certainly grabs your attention, doesn't it? Sale isn't just any company. Their performance, while it's a pretty significant indicator for the whole steel sector and maybe even the wider economy.
That really hits the nail on the head. And that's our mission today, isn't it? It goes way beyond just reading that flashy headline.
Right.
We're going to, pull back the curtain on those numbers. We'll dive deep into sales recent financial reports, those crucial independent auditors' notes, and their official press release.
Basically, get behind the scenes.
Exactly. We want to uncover the full story, the intricacies of what's really driving this performance, and crucially, what maybe surprising details lie beneath the surface. The kind of stuff you absolutely won't find in a quick news hit.
Think of it as the express lane to actually knowing what's going on.
By the end of this deep dive, you'll walk away with, hopefully, a much more nuanced understanding of SAIL's actual financial health.
Yeah, the operational challenges they're dealing with, their strategic moves.
And maybe even some unexpected facts that give you that complete picture.
It's not just knowing what happened, but like why it matters, right, for you.
All right, let's unpack this. It's quite a story. We have to start with those headline numbers, the ones that caught everyone's eye.
The big ones.
That really impressive Q1 FY26 standalone profit before exceptional items and tax, PBT. It leaped to 890 crore rupees.
Okay.
And just to put that in perspective, same time last year, it was only 326 crore.
So that's a huge jump.
When you do the math on that difference, that's where you get that, frankly, jaw-dropping 273% figure.
Yeah.
It immediately makes you ask, how? How did they manage that kind of leap?
That is the million-dollar question, isn't it? Or maybe the 890 crore rupee question here. Looking at the core standalone figures for Q1 FY26, we do see some pretty solid fundamentals.
Okay.
The net profit after tax, PAT, that stands at 685 crore rupees.
Right.
Revenue from operations came in strong at 25,921 crore. Production-wise, crude steel production hit 4.85 million tons, and sales volume was also strong, 4.55 million tons.
Okay.
And their EBITDA, earnings before interest, tax, depreciation, and amortization, that reached 2,925 crore rupees. These are all, pretty robust signs of operational momentum.
And the manager, well, as you'd expect, they're sounding pretty positive. The chairman and managing director, Sri Amardu Prakash, he commented that sales Q1 performance shows, let me get this right, improved operational efficiency, better cash flow, and strong growth in sales volume in domestic market.
Supported by government safeguard duties. I think you mentioned that too.
Yes, exactly. And he really emphasized their focus on cost optimization measures and unwavering commitment to enhancing stakeholder value.
It sounds like a company firing on all cylinders, right?
Well, those numbers certainly paint a rosy picture, but, and this is where it gets really interesting, when you look past the company's press release and into the independent auditor's report.
The checkup from the outside, guys.
Precisely. The deep dive into the books by an unbiased third party, it actually flags several significant areas that, well, they warrant a closer look. This is where we find those vital nuances, the reality behind the numbers.
Okay, so let's get into that. What's the first thing that jumps out? I saw something about a disputed entry tax.
That's right. It amounts to about 106.70 crore rupees. There's this ongoing legal battle over the Entry Tax Act itself. Supreme Court has upheld its validity, basically said it's constitutional.
But specific issues related to it are still stuck in various high courts. Now, sales management, their view is no adjustment is required in their financial results for this.
They think it'll be fine.
They seem confident. But the auditors, what's their take?
Well, that's the crucial difference. The auditors basically saying they don't have what they call sufficient appropriate evidence to fully back up management's optimism.
Right.
They are of the opinion that a provision for entry tax liability should be recognized.
So set aside the money, essentially.
Exactly. They're saying, look, this is a real potential cost. You should reflect it. And if they did provide for it, this, combined with another issue we'll get to, it would actually reduce the company's reserves, their accumulated profits, that financial cushion, by a hefty 415.1 crore rupees.
Wow, so that directly impacts their retained earnings, their buffer.
A direct gent. Yeah. And tied into that, sort of related, there's another significant financial point about the Damodar Valley Corporation, DVC, a refund and an advance.
Ah, yes, the DVC matter. Sale accounted for a refund of about 344.75 crore rupees from DVC, and they adjusted it against advances they'd previously paid.
Okay, sounds straightforward enough.
Well, here's where the auditors raise a pretty critical flag. Sale adjusted the entire amount, the whole 344.75 crore, which included a pretty big chunk of interest, 168.93 crore rupees worth.
Right.
The auditors state this is, and I quote, not in compliance with the requirements of IN AS 109. That's a key Indian accounting standard.
The rule book.
Exactly, the rule book for how you report things like interest income. Ignoring it means the reported earnings aren't quite following the standard playbook, which, affects transparency.
Okay. And there was more with DVC, wasn't there? Something about old advances?
Yes. Beyond that specific refund adjustment, SAIL is still carrying 448.03 crore rupees in advances they paid to DVC way back. We're talking fiscal years 2012-13 through 2016-17.
That's a long time ago.
It is, and the auditors believe this substantial amount should have been provided for. Basically, they're questioning if a sale will ever actually get that money back, citing a lack of sufficient evidence for recoverability.
So that's a lot of detail on the DVC refund and those old advances. But for our listener, what does this really mean? How does it impact the profit they reported? Is this just a technical accounting thing, or does it actually affect the quality of their earnings?
No, it's definitely more than just technical. It really touches upon the quality of those earnings. If that interest income, the 168 crore, was recognized correctly according to the standard,
Right.
it would actually result in a lower loss and higher equity for the quarter for that specific item. It sounds a bit counterintuitive, but it's about how accounting rules classify things.
Okay.
But maybe more significantly, if those old advances, that 448 crore, if that was properly provided for, basically written off as unlikely to be recovered.
Which the auditors seem to think it should be.
Yes. Then that would lead to an increase in the loss and a corresponding reduction in equity. So, while the headline profit looks strong, these points suggest, maybe a potential overstatement in certain areas and definitely a larger financial risk sitting on their books than you'd guess from the main numbers.
That clarifies it. So profit's up, but maybe propped up a bit by how certain things are accounted for, and there's this lingering risk on the balance sheet.
That's a good way to put it.
Okay, let's move to another major point the auditors flagged up. This inventory of subgrade iron ore fines, SGFs, it's valued at a huge amount, 3,849.58 crore rupees.
Massive value. And the background here is that for a long time, these SGFs, basically lower quality iron ore dust at their own mines, they had zero value on the books.
Why was that?
Because of a government ban on selling them, which was only lifted in 2019. So suddenly, this stuff had potential value.
Right, so what's the issue now?
Well, currently, SAIL is holding 40.04 million tons of these SGFs. Huge quantity. But here's the catch. A big chunk of it, worth about 11,195.05 crore rupees, is sitting at their Topilor lease.
Okay.
And it's waiting for permission to be dispatched, to be sold. Crucially, the auditors note there are no alternate arrangements for disposal or internal consumption presently available.
So they have this valuable asset, almost 1,200 crore worth, but it's kind of stuck. They can't sell it or use it right now.
Essentially, yeah. A significant portion is stranded, waiting for the green light.
And the management, from what we read, they're still pretty optimistic about this, aren't they?
They are. Management expects to get the clearances. They point to some recent sales they managed in Odisha. They mention significant market demand for this kind of subgrade stuff, and they even have plans for a future plant to use it internally.
So they believe no adjustment required in the carrying value.
That's their stance. But given the auditors are flagging it, what are the potential downsides here? What if those clearances don't come through as quickly as hoped? Or, what if the market isn't quite as hungry for it?
That's the key risk, isn't it? If those clearances get delayed or maybe don't happen for that specific location, or if market prices for these fines drop, well, SAIL could be forced to write down the value of this inventory.
Which would mean a direct hit to their profits and their equity.
Right. It's that classic difference in perspective, really. Management's looking ahead, optimistic about sorting it out. Auditors are looking at the here and now saying, hey, there's a potential impairment risk here.
Exactly. A potential write-down is hanging over that big number.
Okay, that's a substantial risk to keep an eye on. Next up, another dispute, this one involving water charges. It's listed as a contingent liability of, get this, 1,116.84 crore rupees.
Another huge potential figure.
This goes way back to 2011. The Jharkhand government unilaterally hiked the water rates from the Tenugat Dam. And it wasn't a small hike. It went from 4 rupees 50 paise to 26 rupees 40 paise per 1,000 gallons.
Wow, that's, what, nearly a six-fold increase? Imagine your water bill doing that at an industrial scale.
Exactly. So naturally, SAIL appealed.
Yes, their appeal, LPA number 540-2024, is currently pending before the Arkhand High Court. So it's still being fought legally.
Right. But in the meantime,
Well, despite the ongoing appeal, to avoid any drastic action, like, having their water supply cut off.
which would be catastrophic for a steel plant.
Absolutely. So since June 2025, they've started paying an additional 18 crore rupees per month under protest.
Paying it, but saying they don't agree they owe it.
Precisely. And that entire revised pending bill, the full 11 and 16.84 crore, including interest and penalties, is currently sitting there as a contingent liability. Meaning it's a potential future cost. It could hit their books hard, but it all depends on how the High Court rules. Until then, it's like a shadow hanging over their financials. Not a definite debt yet, but a very real potential outflow down the line.
So another ticking clock, potentially. And beyond these really big-ticket financial items, the auditor's report also touches on a few other things, more around governance and operations.
Yeah, a few crucial observations that kind of speak to the internal workings. First, they point out non-compliance with the Companies Act and SEBI regulations regarding the number of independent directors on their board.
They don't have enough?
Apparently not the required number. And that's not just a tick box exercise. Independent directors are really important for unbiased oversight, for protecting shareholder interests. It's a key part of good corporate governance.
Okay. What else?
They also note that some of the revenue from sales to government agencies, about 2,598.92 crore in Q1, is recognized based on provisional prices. They're still waiting for the final agreement on those prices.
So that revenue number might actually change slightly later on.
Potentially, yes. It's not fully locked in yet.
Yeah.
And then there was that recent situation with the suspension and then revocation of suspension for some directors and other senior officials.
They're below board level officials.
Yeah.
That followed directions from the Ministry of Steel and an inquiry.
Yes. On that, management has assessed that it's not likely to have a material impact on the company's operations or financials.
Okay.
So while these points might seem smaller than the multi-core disputes, they kind of paint a fuller picture of the operational landscape, the governance environment.
Right. These add important context. So, okay, we've spent a lot of time digging into the auditor's concerns, which is crucial for that scrutiny. But let's step back a bit. Because despite these flagged issues, SAIL's overall financial standing still shows some real strengths, doesn't it?
It does, absolutely. We shouldn't lose sight of that if we shift focus to those broader indicators of financial health.
Yeah, let's look at their strategic position.
Well, for instance, their debt-equity ratio, it actually improved slightly, reduced to 0.64 in Q1 FY26, down from 0.66 in the previous quarter.
So a bit less debt relative to their equity, that's generally good.
It indicates a healthier balance, yeah. And their net worth also increased, up to 56,224.27 crore rupees. That's a positive sign, strengthening equity, growing company value.
And something else that really stood out to me was their security cover for their secured, listed, non-convertible debt securities.
Ah, yes, the NCDs.
The cover is standing at an incredible 841.50 times.
841 times. That's huge.
It really is. Basically, for every rupee of that specific type of secured debt they have, they've got over 800 rupees worth of assets pledged as security. That's way above the 100% requirement. It shows incredibly strong asset backing, very comforting for those lenders.
Extremely robust. Their total financial indebtedness, the overall debt figure, is 28,740.97 crore rupees. So it's still a significant amount of debt.
Sure.
But having that kind of security cover is a very strong mitigating factor.
Definitely. But is everything running smoothly across the board? What about performance plant by plant?
Ah, that's where you see a bit more variation. If you dig into the segment performance, Belai Steel Plant, for example, showed strong profit.
Okay.
But some other plants, like the Alloy Steels Plant, Salem Steel Plant, and the Visvesvaraya Iron and Steel Plant, they actually reported losses in Q1.
So it's not uniform success across all units.
No. It indicates that while the overall picture is positive, driven by the bigger plants maybe, there are specific operational units facing challenges. That's something management will need to address strategically going forward.
Right, brings us back to that focus on cost optimization they mentioned.
Exactly. If we try to tie all these threads together, connect the dots, sales Q1 performance, it's really a tale of two sides, isn't it?
How so?
On one hand, you've got this really impressive headline profit growth. That 273% jump is real in terms of reported numbers.
Yeah.
But on the other hand, it's juxtaposed with these significant financial uncertainties and operational questions highlighted by the auditors, like seeing a freshly painted house looks great from the street.
But the inspection report mentions some potential foundation issues you need to check out.
Exactly that. That's a great analogy.
So let's bring it back to the listener. What does this all mean for you? Why does digging into these details actually matter?
Well, it's all about getting that full picture, right? Going beyond the easy headline.
That staggering 273% profit jump. Our deep dive shows it's a story, yes, of impressive operational gains, but also of a company navigating this really complex web of financial disputes, these historical baggage items almost.
Yeah, and those inventory challenges we talked about.
The key insight here isn't just the profit number itself, but understanding how much of sales' true financial position is still, well, kind of up in the air or dependent on future rulings and permissions.
And that's crucial for any kind of long-term assessment, isn't it? Assessing value, assessing risk.
That's
The headline makes a splash, grabs the eyeballs, but the footnotes, the auditor's notes, that's where the real ongoing story unfolds. It shows that for sale, the quality of that record profit, it's heavily influenced by how these legal battles and inventory questions eventually shake out.
It shifts your focus, doesn't it? From just what did they earn
Yeah.
to how solid, how sustainable are those earnings?
Precisely. Management keeps saying they're committed to cost optimization and enhancing stakeholder value, especially with global markets being unpredictable and relying on that government support.
Right?
But the audit qualifications, the points the auditors raised, they clearly show that some significant parts of their financial reality are still in flux, and that adds a definite layer of risk.
So we kick this off with that massive 273% profit jump, a real eye catcher.
Yeah.
But we've peeled back the layers. We've seen a major and industrial player posting impressive current growth, yes, but also simultaneously juggling these complex financial disputes, big inventory question marks, and ongoing legal fights that could really shape their financial statements down the road.
We've seen how the reported numbers can shine bright, while the details underneath reveal this ongoing saga, these crucial questions still waiting for answers.
Which really brings us to a final thought for you, the listener, to ponder.
Hmm.
How do you truly evaluate the real strength, the long-term stability of a company like this, when pretty significant chunks of its reported financial reality are still tangled up in court cases, or hinge on getting future permissions, or depend on tricky market dynamics? What really stands out to you after hearing all this today?